Well, good morning. Welcome to this virtual roundtable. My name is Mark Dunn. I'm the editor of Portfolio Institutional magazine. And I'm going to be your host for this discussion, which looks at how pension schemes are investing through the COVID pandemic. Now, before we start, I thought it was a good place to know, understand exactly who we're talking to, or maybe perhaps even arguing with. You never know. Andrew Chesedine, can we start with you, please?
Yeah, sure. Andrew Chesedine. I'm a professional trustee with Capital Cranfield Trustees across 3 master trusts, 3 standalone DC schemes and 2 DB schemes.
Gotcha. Gerald?
You're on mute,
Sorry,
Gerald.
you need to unmute yourself.
Sorry, I'm a professional trustee with PSGS, and I also am on 3 master trusts, DC master trusts, and then a range of DB sole trustee, chair, and trustee appointments. And all of those are ongoing.
Okay. And Neil?
Yes, Neil Mason. I'm a strategic finance manager for pensions and responsible for the Surrey County Council Pension Fund, which is a local government pension scheme. Value is around about 4.5, or was around about 4.5 billion, with 100,000 members. I'm also independent member for the London Borough of Hounslow Local Pensions Board.
Okay, good. And last but not least, Andy Stevens.
Hi, morning. Yes, so Andrew Stevens. I work at BA Pensions as an investment specialist, and that is largely on their 2 very large DB pension schemes.
Okay, guys, thanks for that. Now, when we took our Christmas decorations down in January, very few people in the world had heard the name COVID-19. We're now talking to each other in June, and since then, in the UK, that is, economically, there have been 2 cuts in interest rates. There's been an emergency budget. Our national debt is now larger than GDP. The Bank of England are having to inject £100 billion into the economy. In April, the economy contracted by 1/5, which is its largest ever monthly amount on record. So it's safe to say that even though we are, some of the lockdown conditions that were implemented in response to the crisis are being eased, there's still a lot of uncertainty about how the economy will look when this virus is nothing but a memory, but whatever it is expected to be quite troubling, quite tough. And what I want to get to grips with today is to find out exactly how pension schemes of people who are there investing our money and monitoring our money and taking care of it to help fund our retirements, how they are performing during all this. So a good place to start. Neil, if we could start with you, how have your investment portfolios performed during this COVID pandemic?
So we were in a nice position as of, it seems like an age ago, March 2019, when we had our formal valuation, and we were able to tell our stakeholders that we were fully funded. At the point of the highest point of the fund, it reached 4.5 billion, and during the worst point of the pandemic, the fund went down to as low as 3.7 billion. We've made significant recovery since then, and the fund is now valued around about 4.3 billion. I suppose from our point of view, we're an open scheme. We've got free cash flow. We don't have any immediate concerns on our income, so we're in a comfortable position in the sense that we can look at long-term trends and take a long-term view. So while yes, we've suffered significant losses to the portfolio, we are still delivering on our long-term investment strategy and meeting our funding targets.
So that's a great position to be at a time like this, Neil. Andrew Stevens, how are things performing for you at the moment with the BA?
Yeah, sure. So, obviously, look, the recent volatility was was punishing for sort of equity holders and actually risk assets, obviously combined with gilt yields falling, so liabilities increasing. So not a great combination for DB pension schemes, depending on strategies. So just to put that into context, so we have two large DB schemes, and they're actually in very different positions, but with different maturities. So first of all, there's the Airways pension scheme, or APS, which is a lot more mature. So that's been sort of cash flow negative for some time, closed for new entrants for a while, and actually well progressed on de-risking journey. So 90% hedged on longevity, 75% bought in through insurance contracts, and fully hedged on rates and inflation on the remainder. So, that's a very well hedged position and close to the end game. So in terms of impact, there was not really a material impact by the volatility in March. I'd say circa 1% reduction in funding level, which, as expected, due to the well hedged position. So that's one story. And then there's also the new Airways pension scheme, so NAPS, which is much less mature. That closed to accrual sort of 2018, but that's less hedging in place than the APS scheme. And the asset makeup is different. So let's say around 45% in return-seeking assets, and not fully hedged yet against liability moves. So look, obviously, falling gilt yields it was only partially offset by the rise in our hedging portfolio. We do have work to increase that, but look, like a lot of schemes, it was more affected by the falls in equity markets and the spreads widening. So we had sort of a circa 10% fall in funding level for the NAP scheme at the depths of the crash, and we've now recovered sort of about half of that. So it's obviously made it quite challenging, and there are actually quite different stories there depending on which scheme you're looking at.
Gerald, a lot of pension schemes are sort of cash flow negative or heading towards it, and have implemented cash flow driven investment strategies or LDI strategies. And we just heard there that Neil's, there's a lot of cash flow there. They were fully funded a few months ago. With some of the schemes you're working with, how has the current pandemic impacted some of their strategies?
Well, I tend to have some fairly underfunded schemes in my portfolio, okay. So they tend to be more risk on. I've only had one where I've had a delay in deficit recovery contributions, but I think that will be just limited to one quarter. In the case of the others, there's one where we have about a 60% equity allocation, half of which is hedged. And when the market recovered to some degree, or bounced back, we decided to take a little bit out of our unhedged position and just stick that in cash in the bank. This is a very mature scheme, cash flow negative. We'd already had 3 or 4 months worth of pensioner payroll. What we didn't want to be doing, because we took a view there might be another dip in the market, we didn't want to be liquidating further equities later on. We thought being slightly better hedged at these sterling levels might be a good thing, so we took it out of the unhedged position, and so now we're pretty comfortable. I think we sold just below sort of the new peak, as it were, after the crisis, but I think we were comfortable doing what we did. It was still somewhere just around 10% down on where we sold it, with asset values in the assets that we sold about 10% down from the beginning of the year, but that was a lot better than the 27% or something that we'd suffered across the portfolio. So in the case of other schemes, we've really been riding it through. If you take a look at the pandemic, you've got to be pretty agile to catch. You look at the price of gold, or even gilt suddenly shot up when everybody was scrambling for cash to cover their collateral positions. So I think as a pension trustee, I've been very loath to make tactical decisions other than the one I just mentioned, which was for practical reasons, really cash flow reasons. And the other, of course, is, we may come to it later, there's been obviously some funds that have been frozen, but I think that's probably something for later in the conversation.
Okay, and Andy Cheseldine, same question to you, really. I mean, how's it impacted the schemes that you're working with?
Well, from the DB schemes, I think I'd probably just say, yeah, what they said. Clearly, if you're fully matched against your liabilities, then it's hardly made a difference. If you're not, then there's been quite a lot of volatility. But I wouldn't want to start playing tactical investment if you've not done it before. The DC side, actually, DC's come out of it, I think, pretty well. Most of the members are in lifestyle. At the worst of the market, early April, if you are between anything up to 2 years before retirement, you've actually seen your fund go up in the previous quarter, which is great. Because people retiring know they've got a relatively safe environment to take their income. Clearly, if you're much younger, you saw 25 to 30% drop in the value of the fund, but you've got 20, 30, 40 years to go to retirement. So it's broadly irrelevant, possibly an advantage because you're buying cheap. But you probably don't want to start talking about pound cost averaging to members. So overall, they've done pretty well. But it's clearly, it depends on the type of scheme and how well matched you are against liabilities.
Yeah, good. You raised some interesting points there. Has anyone made any, I mean, we heard what Gerald's talking there about study stuff. Has anyone made any changes to their investment portfolios during this period of volatility? Any changes at all you guys have stepped in and made? That's an open question to anybody.
There's nothing that we've decided to do since. We've been going through in some of my master trusts a change that had been planned before, which was moving more into ESG stocks in the growth element. But I think everyone's looking to see what the long-term trends might be. There are bound to be some, but there's an old line that if you've never done stock picking before, why do you suddenly think you've suddenly got so good at it? So think about what you're trying to do. If you're a passive investor, perhaps stick to that. There's an argument that some industries will do quite badly in the future, and you might want to come out of those. Airlines, perhaps, cruise liners, but there are also industries where maybe up to 25–40% of the stocks within industry might fail. Think hospitality, hotels. The businesses with good balance sheets will probably survive and do really well in the longer term because their competition is going to go out of business. So where do you look for? And there is some element of stock picking in that, but you've got to go through the professional use of it. So at the moment, we're waiting on things subsiding a bit, I think.
Okay. So is this they say volatility is an investor's friend. Is it a good time to go and snap out some bargains, or are people going to be a bit more cautious in terms of the uncertainty that we're seeing at the moment?
I think I would echo Andy's comments about unless you're going to be an active stock picker, and certainly on an individual basis, I've picked up a couple of bargains during the period, but that's just looking at long-term value with stocks that I like. I wouldn't want to be doing that as a trustee because I think one's got the weight of responsibility of the membership on your shoulders, and I think picking those winners and losers, I think, can sound fairly easy as Andy described it. Actually finding those and making sure that the value there's continues to be value and that somebody hasn't got there first, I think is a tricky one. While I'm speaking, I would like to echo his comments also on the Master Trust. I think I've been heartened about the fact that those nearing retirement have not suffered unduly because of their de-risked positions, and those further from retirement, I think, because of the pound cost averaging and for other reasons, probably end up doing slightly better. I think the one element that I always like to do is look to and through. What is the end result here? If your time horizon is long, then volatility isn't risk, it's volatility. If you need the money soon, obviously volatility is risk. And so I think the tendency for the schemes that I'm involved with to look through this crisis and acknowledge that there might be a second wave and further trouble in the market. But if one can look through that, then I think the view is it's really difficult to try to outsmart the market and do well. So I think there are some other issues that come out of the pandemic as to what the long-term interest rate environment is going to be and what pension schemes do about that. But that's not related, I think, so much to what we're experiencing right now.
Like Gerald, I've managed to pick up some bargains through lockdown. I managed to get that thing that you can cut your hair with at home on Facebook. But what we've done, we did make a decision early to be overweight in cash while we were looking at our employer covenant. Now the economic rescue package from the government has come through to most of our employers who are in one way or another connected to government spending. We have seen some opportunities with the current credit spreads, and so we're slightly overweight in multi-asset credit, and we've deployed some of our cash just recently in that area.
Gotcha. And what about you, Andy?
Yeah, sure. So, I mean, it does echo a lot of what everyone else has said. So, look, across NAPS and APS, our two schemes, we haven't made any wholesale changes in response to what's happened. Anything that has happened is sort of things that are going on anyway. And I think I'll maybe go a bit general. Look, I think, are there any bargains? Is it the right time to snap something up? I think for me, it's only a bargain if you actually need or want those assets. So let's think in terms of, is it part of your target allocation or the strategic framework, and even within your IMAs, etc. So I think on one hand, stick to those investments that you need, and it's a strategic decision. So obviously you could say, oh, it's a nice time to go into high yield, but if you had no intention of ever having high yield in that, and it's not part of your plan, then that's a very tactical decision, and sort of echoes what a lot of people have said of, we're not going tactical and making those sort of off-piece decisions in a large sense. And look, more generally, yeah, I mean, if it's part of your strategic direction, look, spreads blew out, they've come back a bit. Was there an opportunity there to get higher sort of spreads and lock in than maybe you were planning before? I mean, if you were going to add more capital to corporate bonds anyway, or can you get higher quality credit ratings compared to what you were going to get before? And it's things like that, but certainly making those decisions on a strategic basis. And there are other considerations as well. So is there a bargain? There's obviously transaction costs, liquidity was constrained. So if, and if you're going out and coming back around, it's a tactical decision, there's round trip costs. So there's a lot of things to think about. Equally, where do you source that from? If schemes think there's an opportunity, what are they going to come out of to fund that? So there's lots to think about.
Yeah, I think that just highlighting a couple of points there, that if you are going to snap up a bargain, you've got to be selling something else. And, is that the right time to sell? And I think the other point that you made there about credit spreads, they did widen substantially for a very short period of time. You'd have to be pretty much on the ball to have captured the majority of the value that was on the table for a brief period. So I think that underpins some of the comments earlier that, to catch those bargains, you needed to be having your finger on the red trading button and also be pretty smart.
Yeah, I agree with that.
Just to echo Gerald's point, I agree entirely, but to bring it back again to DC, Clearly, DC is cash flow positive. It's got a raft of new contributions coming in on a regular basis. So now is potentially an opportunity to do investment that I know we briefly talked about into whether it's ESG or something that we think is a long-term good bet.
Yeah, and I'm also involved in the ESG side. I think that's going to be a trend. I think there's going to be a lot of money chasing those best structured ESG assets.
Okay, gotcha. Okay, interesting. I'm sure we'll come on to ESG later. You talked there about long-term good bets. A new market has emerged, and that is funding the fight back against this pandemic. It's about governments, companies trying to raise capital to try and restart their companies, restart their industries, restart their economies, if you like. Have you guys, I mean, Neil did mention earlier on about investing to do with government spending and all this. Would you guys be interested perhaps in this new very niche market? I mean, I've heard these things called COVID or virus bonds that have been issued to help fund the phone back. Is this something maybe you think is a little bit too short term, because there's a lot of uncertainty about when things will improve?
So I think, echoing points made by the rest of the panel, it's something we've looked at and had discussions with our advisors, but it doesn't really fit in with our long-term strategic asset allocation. So it's not something we've given serious consideration.
Okay. I mean, at what point for you guys would it have to be to give it consideration? Because obviously, if this continues, we talk about second waves, and the governments around the world are borrowing a lot of money.
Well, yeah, I mean, we're looking at what we have done is, I'm sure, common with most funds, is we've looked to map some of the potential recovery, the alphabet of recoveries, and I think the situation is evolving in that space. I think the probability of a W recovery is generally seen as the highest, and when that situation will only play out towards the end of the year, when the likelihood of a second wave is higher, and we'll obviously react to that. But we're planning on the probabilities of there being a W-shaped recovery, and our strategy is reflecting that.
Without wanting to be too glib, you could just call COVID bonds gilt, because it's a passive basis. You're lending to the whole of the industry, because it's the whole of the economy. And if you get into specific stock COVID bonds, then you're going into a world of risk. And back to my earlier point, and everyone else's earlier points, do you really understand what you're getting into?
Yeah.
And I think pension, certainly DB schemes, have an asset allocation. I think Neil was referencing this, to suddenly turn around and say we'd like to consider something new that comes down the pike. Unless it really suits with the existing strategy, one would really need to go through a review of one's asset allocation, and that is something that schemes tend to do on a sort of scheduled basis.
Gotcha. Okay. Good. Andrew Stevens appears to have dropped out at the moment, but he's probably got a problem with his internet connection. Andy Chesedine, what would be the worst case scenario for your schemes in terms of a recovery, or how this pandemic plays out?
Oh, gosh.
Yeah. And are they prepared for it?
I suppose a long-lasting, if we went into a Japanese scenario, or if the world went into a Japanese scenario. But there are lots of things that can go wrong at the moment, and I think diversification is the only way out of it. So pandemic is just one thing. We have Trumpian politics. We have China apparently wanting to pick a fight with India, with Taiwan, with Korea, with the US, with the UK, Hong Kong. There's a lot of geopolitical risks out there, and there's a lot of economic risks that are not related to pandemic. So I'd argue that the pandemic itself is what potentially is existential. It kills too many people. I mean, what's going to happen in the US? They don't appear to have it under control. And the US is half the potential stock market in the world. Yeah, slightly less, I think, but it's not far off it. We've got some major issues to consider.
Okay. Andy Stevens, for the BA pension scheme, what is the worst case scenario you guys can deal with in terms of, in terms of the recovery and the impact on the economy and the markets, and where things get out of your control?
Yeah, sure. So in terms of the pension scheme, so as I said, there is two. So in terms of apps, which is very well hedged and far along on the journey, it has limited reliance on covenant at this point. So I think let's park that one in terms of the question. In terms of NAPs, I mean, what we're currently doing right now is a lot of scenario testing and considerations. So obviously, that's a lot of gaming to see what comes out of the economy and where things go. And obviously, look, there is a big link to the employer covenant there and the sponsor. We know that. So I think a lot of that will include, some positives. Is that a good recovery? And that will include some serious downside ones. And obviously, from an integrated point of view, we'll be definitely looking at support from the sponsor in all of those solutions. So there's no definitives yet because I don't think we know how it's going to play out. But I think what you can do and what can help is those scenario analysis and thinking what could happen. And actually what's useful from that is you've already discussed it. You've already had those difficult conversations. You already know from that a plan of action should, X, Y, or Z occur. So I think that's probably the approach we're taking in terms of, look, we don't know where it's going to go, but at least we have a plan and we're ready depending on the outcome.
Gotcha. Okay. Does anyone believe this COVID crisis will have a long-term impact on pension funds, whether that be DC or DB? Or do you think this will just be a little blip and things will carry on? I mean, a lot of you have talked about just continuing with your normal investment strategies during this period.
Yes and no, I'm afraid, is the answer. It depends. I think Gerald's probably the only one who's approaching my age on this call. So I've been through a stock market crash or fundamental financial crisis probably every decade since I got into the industry, which was in the 1970s. So being there, seen that, got the t-shirts. This time feels a little bit different, but only because of the nature of it and the fact that following SARS and MERS and others, I wouldn't put money on this being the last of the pandemics. Yeah, I suspect there'll be more. So we need to become more resilient as a global economy. But I'd argue, therefore, that we've seen this before and we can get over it. But there will be big changes to pension schemes. I think we'll have to think about where we're investing for the future. I think if you're predominantly matching your liabilities in either gilts or bonds, then you're probably mostly okay. Derivatives are probably okay, but who's your counterparty? It's when you get into growth-seeking assets that you're going to have to be more careful, I think. And there'll be winners and losers out of the market, outside of the pandemic. But we shouldn't confuse, when you look at size of economies, we shouldn't confuse investable size with market size. So we need to think about who's operating in which markets. So it's a very broad answer and doesn't probably answer your question anyway.
I'd echo a lot of that, and I think there's a couple of things to mention. I think one is liquidity. I think the illiquidity premium has been this thing bandied about that's what pension funds need to do. If you don't need the money, you lock in that premium, which has been somewhat elusive occasionally anyway. And I think some of the market volatility and the scramble for liquidity right in the middle of March there, and the realization that corporate bonds maybe aren't so liquid, even though people sort of knew that already. So I think that'll be a lingering effect. I think just a reevaluation of illiquid assets. I think the other, which is more fundamental for pension funds, okay, if you are already hedged and so you're funding yourself based on a hedge position now, that's one thing. But we've had an unprecedented lowering of interest rates, descent of interest rates for 30 years, I suppose. We thought sort of bottom, and now we may be going more negative. I noticed, gilts are negative out to 5 years now. The 10 years is 22 basis points, I think, today, and even a 30 years is 69 basis points. So is that a good asset to invest in for pension funds? Well, if you're already hedged, then fine. But if you're not, what is that? If you buy them, your upside is that interest rates go down further, but the yield that you collect on them in the meantime is pretty meager, putting more pressure on sponsors. So I think it's going to be an interesting dynamic, I think, where the relationship between equities and bonds, which actually worked pretty well through the crisis, but that has a finite end at some point. And I think there's going to need to be, over the next few years, depending on what the path of interest rates, perhaps a reevaluation of that age-old equation. If your fixed income assets aren't able to return an adequate investment return to you, then what else is there? And of course, then you look around the other asset classes, and equities have their own issues. So, but they tend to be the place where people end up when they can't think of it, can't find anything else that looks like it will deliver the growth they need. So I think there will be longer term lingering effects based on, as a result of that. And it's difficult to really read where exactly we will end up.
Andy Stevens?
Yeah, actually, that's an interesting point that's raised there on the hedging. So I think it's clear that those schemes that were under hedge in terms of interest rate movements, or less hedging, should we say, and those with perhaps also less diversifying assets, they would have suffered probably on average the most. The interesting point there about the hedging is, ultimately taking interest rate risk in terms of the liability movements is an unrewarded risk. So there's the yield point just talked about, but I would see it as it's just try and, if you can get as much hedging as possible, because that is just an unrewarded risk. I'd echo the point on sort of longer term impacts. Yeah, liquidity, it should already have been looked at by schemes, and monitored and looking at those risks in terms of strains and holding buffers and things like that. But I think it will bring it even more into focus in the future. Then, people have mentioned it, but leverage, counterparty risk, the cost of funding, sort of roll risk. I think they already were being looked at, or should have been, but I think they'll even come to the fore a bit more. And then just a final thought, actually, sort of long-term damage, pension schemes or not. So a lot of schemes will have taken a hit on funding position, but actually when you project that into the future, I think you'll see a lot of sort of investment houses or ESGs will project the future position. They might make allowance now for higher returns from certain assets. So there is a little bit of a countering factor there, that credit, for example, I think equities, you've probably seen some of that increased return already come through, but forward-looking assumptions may actually have higher returns now.
Are members still paying into your schemes?
So largely, there is a bit of future accrual, but largely this is done. But a small bit of actives, yeah.
Okay, but I mean, we're reading in the press that BA are making redundancies, and there are reports that they're asking staff to take pay cuts. So if that's true, I mean, will that have an impact on what those guys were paying in, still paying in?
Well, I personally don't have the details of which sort of people they're talking about, were they in the scheme or not. So that's a sort of hard one to answer.
But for argument's sake, if they were, that would definitely have an impact on
So look, in terms of apps, look, that's cash flow negative already. That's closed. Yeah, look, you're going to be cash flow. If you were getting cash flows in the scheme and now you aren't, you've got to think about that. That's a liquidity point of view to think about. That changes the dynamic. Actually, it's also interesting when you think of what's just happened and employer covenant, and actually general people's view of the companies and the sponsors behind the schemes is, will we see what transfer value activity will we see? So in terms of our schemes, look, in terms of difficulty in working from home and systems and things like that, temporarily transfer values were suspended. So that's a kind of operational liquidity point of view.
Okay.
That's temporarily, but yeah, into the future, let's think about it. There's also liquidity considerations on cash flow coming in, but also transfer value requests. So I think it's an interesting one. I think it's a watching brief on how it plays out then.
Okay. Gerald, in the DC world, of course, members are still paying in. It's the way it works. If people are losing their jobs, or if people have to take pay cuts, or if career progression in the coming years is slow, that means people are paying less in. So that will obviously have a long-term impact on what kind of gains they can get back from the markets, surely.
Yes, we've seen in my schemes, we've seen limited effect. And I think what's encouraging, I saw a study yesterday, in fact, about the number of employers that are still paying above the auto-enrollment minimum into the schemes. The ones I'm involved with tend to have slightly higher paid members. But the way things progress, some of the in a master trust, some of the sponsors are suffering, sponsoring employers are suffering more than others. But overall, the trend is very much to put more money in and to put that to use in a way that will both engage the members and engage future prospective sponsoring employers. So we haven't really seen a negative effect of those who are who no longer have a job and therefore not contributing. It's been fairly minor, and so the trend of new money coming in remains. And a lot of, if you take a look at the average age of a lot of these members of master trusts, it's a fairly low average age in many cases. So this is often earlier in your career, you can be a bit more nimble. And so I don't see that as a well, around my trustee boards, that isn't an issue of major concern. I think what has been of major concern is messaging to members to make sure that they don't jump out at just when the markets hit bottom and get it in cash and sit on it until the market is fully recovered and then buy again. We haven't seen a huge amount of switch activity or a blip in it, though there has been some evidence of members hedging their bets, taking half of it out in cash and keeping the rest in. But by and large, the messaging to members that says you're investing for the long term has encouraged them to stay put. And clearly the focus has been on those nearest retirement as to, if they're going to have to cash in their pot, or they're going to buy an annuity, or they're going to do something else with it, that it isn't too volatile. So I've rather strayed from your original question, but those are some of the issues facing the master trusts where I serve.
I echo Gerald's comments. We haven't seen very many members make a decision to stop contributing on their own behalf. They just carried on as normal, frankly. Where we've seen redundancies and furloughing, that we've seen a bit of that. We expect to see a lot more, but we think that's going to be a temporary blip. If you're cash flow positive to the extent that master trusts typically are, reducing that cash flow by 10% even is a fairly temporary blip. They're massively positive. If I take just one of my schemes is Smart Pension, which I chair. So around about 40,000 employers, around about 800,000 members. there have been reductions in the number of members contributing, but it hasn't been enormous, to be honest. It maybe go much further in due course, but a lot of our clients are relatively small, so they're not the traditional large employers of hospitality, etc., and they haven't been as badly affected. If I can just jump back, the couple of points in terms of systemic risk to pension schemes. One of the ones that, sorry, I don't want to sound morbid, but we did think that COVID might create so much mortality, it might help some DB schemes in terms of removing the older pensioners. Fortunately, that hasn't happened too much. But what we are seeing, I happen to know quite a lot of medical friends, and they think that this will end up creating a more long-lived population. They think that so much of the research that's going on at the moment will be applicable across the board. And actually, there might be a systemic threat to DB schemes in particular, and if it comes to that, to DC schemes, in terms of members need to realise they're going to live longer in the future, because medical advances are likely in the long term to come out of all of this.
Just one comment on that longevity. I think it'll be interesting to see from the point of view of mortality, whether what is more important after the fact, COVID-19 or the people who didn't get seen in hospital because of COVID-19. So I rather think the longer term effect on cancers and that kind of thing will be as impactful in the non-COVID cases. But of course, time will tell.
Andy?
I think that's actually an interesting point on the longer term, and does it have will it be a detriment to funding in terms of people living longer? I also agree on the point just made on people that weren't seen, but I suppose I think that's interesting from the funding point of view. So obviously there's money piling in and time and cost and research into getting a cure for COVID-19, but yet to the extent that there's just significant focus and funding for other things in the future, I could certainly see that being a potential outcome of more knowledge and people changing that trend, which of late was longevity coming down slightly in terms of the trend, but increasing. I could see that.
Time is chasing us up now. Can we just end by talking about ESG? It's a very big issue at the moment with members and with government. This has been, quite a test of ESG's credentials as a risk mitigator. Is that what you guys are seeing? I mean, ESG, is that those sort of strategies holding up during this time?
Yeah, I mean, ESG is obviously a critical part of our risk matrix. I think that if we look at the situation that we've had in China, it does ask serious questions about, particularly the S part of that of the ESG. As a fund, we've been pretty much on the front foot with this, and we are currently in a process of looking at mapping the portfolio against the United Nations Sustainable Development Goals to help to inform our committee, which is obviously the decision-making body, in how they develop their core investment beliefs, which will drive us through to the next stage of our strategy planning. So I think it's a difficult question as to how ESG. Obviously, there are big pressures on how we can build a sustainable capital model, but we also need to bear in mind that we are talking from the developed economic places. There are regions that haven't gone through that economic development period, and they need to have capital available to develop their economic standards of living. So it's not an easy question to answer.
ESG is a very broad church, of course, and there's a lot going on, and so yes. Does anybody have a final point to make on the topic of ESG?
I suppose just that in answer, I think you were asking how ESG behaved through the crisis. So just a couple of comments there. One, I think by and large, those ESG tilted funds have outperformed during the crisis. That's partly because they were underweight oils, and oils have underperformed the market. And there's a couple of other factors there. So I do think that the if you want to call it the road test, maybe has proven. But the bigger picture with ESG is that I think the market now realizes that an ESG focused fund will not only deliver good for us all, but better financial results. And the fact that the road test seemed to work in COVID, however relevant that actually is, will be helpful to the long-term trend, which obviously is underpinned by regulatory change. And so I think every master trust, whether they like it or not, for example, on the DC side, is having this on front and center of the agenda from an investment point of view. And I think from a DB point of view, the larger schemes like Neil's, have been taking it seriously for some time.
I think I totally agree with that, and I think that the new stewardship code talks to that, and will require managers of capital to really take this whole ESG question, not just take it seriously, not give lip service to it, but actually have tangible metrics that we're reporting to.
I think it all boils down to quite an old phrase of enlightened self-interest, and I absolutely agree with Gerald's comments.
I'll agree with those comments as well. And yeah, just to say, look, a lot of focus and resource has gone on the COVID response, but equally in terms of our agendas, ESG and related points haven't dropped off the agenda. They're still there, and it's still a focus and still important. So it's just COVID was another thing to tackle and think about, but it hasn't changed the direction of travel.
Okay, so ESG is still a factor in terms of making decisions about the portfolio. It's not being ditched as old pause and thinking, well, we'll come back to this when things pick up.
Not in terms of our thinking. It's not been ditched. Like I said, it's still on the agendas. It's still in the thinking, and obviously trying to embed that into the whole process. In terms of new investments, monitoring, and all the thinking. That's still absolutely the plan. Yeah.
Great.
The one element I think will be interesting will be the social side of things, whether company behaviours through the downturn, the way they treated their employees, their suppliers, etc., whether that ends up by having a greater proportion of the weight of argument in the future or not. But again, we'll see how that plays out.
It's obviously an awful lot easier for DC than DB. Back to, I think it was probably Gerald's point earlier, that if you're already invested in something, it means you've got to sell it to move into an ESG focused fund. DC is cash flow positive and will be for the next 30 years, and very cash flow positive at the moment. And it's really easy to transition to ESG. Smart is expected to be about 70% ESG within a year.
I mean, on that question, I'm thinking of we think of as ESG as stewards of assets. The recent Supreme Court verdict has opened up some questions about what the relationship is between the owners of assets and the managers of assets, and what the duty is for, if I'm talking from a DB and an GPS perspective, to meet the requirements of our members when we're investing on their behalf from an ethical, social, and governance point of view. So, I mean, that's a really interesting question, and that's a developing question too.
Okay,
just
guys.
Sorry, I was just going to say one final thought on, so are there changes schemes can be making to allocate capital to maybe more ESG positive investments? There's also a point of just engagement as well. So, maybe it's not high turnover. Instead, maybe it's just increase that engagement, trying to get those companies behind investments to change and increase those standards. So I think there's two aspects to it, not just going for the quick easy win as well. just a final thought.
No problem. Thank you, Andy. Well, thank you, guys. It's been great to talk to you about what's going on. And I'm sure if we all got together, the 5 of us, this time next year, hopefully things have turned out okay. But hope that you all stay safe and everything goes well. Thanks for your time, guys. Thank you.